Hi everyone, it's Brian from stockcalc. I want to take a bit of time and go over the Facebook fundamental valuation blog we posted yesterday. Go through some of the details in the report. So if you're interested in fundamental valuation or you're learning valuation, hopefully this is a good video for you to give you a better understanding of the tools that are used. You can access the stockcalc website directly and actually take a free 30-day trial on the registration page here using the promo code stockcalc30. That will allow you to run valuations for any of the 9,000 companies we have in the database for the New York, NASDAQ, Toronto, and Vancouver exchanges. The report starts with a valuation summary, so you can actually see 6 valuation models or points that we use in analyzing the company. The first is a discounted cash flow analysis. I'll go through the details of that in a bit. Then we look at comparables or relative valuation models, where we compare the company and use the ratios of another company or companies to come up with a valuation for the company that we're interested in. Multiples is essentially the same as comparables, but we're comparing the company to itself over time. Adjusted book value is similar in that we're using the company's balance sheet and comparing it to its historic price to book to come up with a valuation. And finally, the consensus data that we have for the analysts is also provided. The report contains an overview on the company, so some trading information, current price, bid-ask at the time the report was run, a chart showing the price trend over time, some background information on the company, the description of it. Facebook's a well-known social networking website. Then we go into the financial data for the company. So the income statement, balance sheet, and cash flow statements, total revenue, EBITDA, net income, number of shares outstanding for the last 5 years. Balance sheet, we have assets, liabilities, and equity, again for the last 5 years. And cash flow, 3 different sets of cash flow: operating, investing, financing cash flows. We also have 4 sets of ratio data for the company. The ratio data gives us points in time and percentages, things like sales per employee you see here. Others that we may be more familiar with, something like return on equity, price to earnings ratios. So all of that data is contained within the ratios section. All of the calculations for these are all within the stockcalc site, and there is, in the help section, there's a description of each one of these ratios and how they're calculated. Then we get into the actual details and assumptions. So for every company that we run a report on, we create a cost of capital. What this is the weighted average of debt and equity at their rates. So in this case, Facebook has no debt on its balance sheet, so the company is financed through equity, and what we use is the cost of equity, or KE, and we've actually calculated the cost of equity for Facebook to be 7.94. Since there's no debt or preferred equity in the company, we end up with a cost of capital, an average cost of capital of 7.94. If the company had debt, we would calculate the blended rate here for the cost of capital. So for example, if this was 50-50 and that was 8 and this was 6, then we would have an average of 7 for a cost of capital. You do see a small cost of debt here calculation, but it's insignificant. Obviously, there's no amount of debt on the balance sheet. There's less than 1% debt in the capital structure of the company. Some more information here. Analyst data. Then we show the analysts that we have covering the company, and we show a snapshot. So the revenue targets that we have, price target for the year that it's associated with, the number of EPS and revenue targets that we have, and then all of the other data that's available. Larger companies like Facebook, we have a lot of coverage here. For smaller companies, we may not have a lot of data in these boxes. But you can see things like the debt that's outstanding, the EBITDA, the net income. These are all projections on the analyst data, 2017, 2018, 2019. With those projections, we can actually then create a forecast for the company. So a total revenue projection of 37, 46, and 56 billion respectively. 37, 46, and 56 coming out of the analyst data that we have above. So we actually use the analyst consensus where it's available to create a forecast for the company. With those forecasts, we can then actually generate a discounted cash flow analysis. And there are a few things that are important for a discounted cash flow analysis. We need an expression of cash flow. And what we do is we use EBITDA as our expression of cash flow. So EBITDA being earnings before interest, taxes, depreciation, and amortization. You can see 21, 26, and 35 respectively. 21, 26, and 35. And then something we call a terminal growth rate. This is the growth rate we expect the company to continue to grow forever beyond our last year. In a lot of companies, you would expect this to be much higher, but this is a growth rate long term. So in order to have a long-term growth rate, it tends to be in the 2 to 3% generally. For very large companies, sometimes it can even be smaller than that. There's some other important pieces of information such as tax rates. So the tax rates are applied to the cash flow to generate an after-tax cash flow. We also use the cost of capital that we calculated above. So we actually take the cash flows after taxes. We look at what the company needs to spend for capital investment. There's a tax shield associated with that, and then any incremental working capital. So you can think of these in terms of if the company needs to add capital for investment, for buildings or machinery or things like that, or if they require additional capital for managing short-term investments, payables, receivables, that sort of thing. All of that is distilled down into a discretionary cash flow, which is discounted to the present. So this is called a discounted cash flow. So what we're doing is taking cash flows, making adjustments to them, bringing them back into the present time. So we end up with what we call an enterprise value for the company. So this is all the total projected cash flow that the company should generate for the life of the company. If there's any debt, we remove it there. If there's preferred shares, we remove those as well. And then we divide by the number of shares outstanding to actually come up with a value per share. So I'm going over this fairly quickly, but this allows you to get into more depth on it on your own. Using comparable companies, what we use are ratios. So we take a look at the company's metrics such as earnings per share, book value, sales, cash flow, and EBITDA. And we look at the ratios from the comparable companies. So as we saw up above, it was Google that we were using. So here are the ratios for Google. Generally, we will use up to 5 companies if we have them available and the matches make sense. But in this case, we only have one company that matched with the criteria that we're using. So Google's PE ratio is 29, Facebook's is 38. So on that basis, we end up with a price value of $103. Same thing here, 4 for Google, 6 for Facebook on a price to book ratio, we end up with an $83 value. So you can see the values that are generated here. So using just Google as our comparative, we end up with an average valuation of $83. So all this is if you take the 2956 times 3.49, you will get the 103 as the value. In stockcalc, in the site, you can actually add other companies and come up with a different average value and adjust these calculations accordingly. Then any comparative company information we have for those different ratios is shown in the report as well. Other ratios are really for companies that do not generate revenue. So if you're dealing with junior mining companies, for example, or pharmaceutical companies, we're looking for ways to try and value these companies compared to others in their group. So for companies that are generating revenue, these aren't as relevant. Multiples is basically using the company's own values over time. So as of the period of time that we've cut this off, here are the earnings, book value, sales per share, etc. for Facebook. Here are the ratio averages over the period of time that we're dealing with, and the comparable prices. So with a company like Facebook, we know that the ratio averages are coming down. The ratios were higher previously, so we would expect to see quite high prices based on comparables, and we would expect to see these ratios come down over time. So we end up with a valuation of $187 using that. For a stable company that's been in business for a long time, you would expect to see these line up very well, and we would end up with a valuation that would be very close to the company's current price. Finally, the adjusted book value, we basically calculate the book value. So if I go to the bottom here, it's the equity for the common shareholders divided by the number of shares outstanding, gives us the adjusted book value per share. And in stockcalc, we can actually adjust these columns because we're showing the book value column. So this is what we see on the balance sheet that the company presents. And then we can adjust those values if we want to something we call fair market value, which allows us to adjust basically from what it is on the balance sheet to what we think it would be available for sale at market. It could be that cash, for example, generally stays the same, but short-term investments may be different. Maybe receivables aren't the same. The inventory could be different. The assets certainly could be different. They could be much higher or much lower. What we do with that is we take the adjusted book value calculation and multiply it by the average price to book ratio for up to 10 years if we have it. In this case, we only have 4 years worth of data. So we have an average price to book ratio of 6.82 for Facebook over the last 4 years, which is higher than what we would expect for traditional companies. We would expect 2, 3, or 4 probably for traditional companies, but for technology companies like this is not uncommon. That gives us a calculated value of $139 per share. And then finally, we take the data that we have from the sector that it's in, the industry that it's in, for representation purposes. So you could actually see Facebook's PE ratios, so right off the charts here in 2012, versus the industry that it's in. And its numbers would be part of the industry that it's in. So in 2012, the average was 45 for a PE ratio compared to 2,600 for Facebook, so just coming into profitability. Even in 2015, 105 versus 49, so it's still 2x on PE ratio. It's almost 2x on price to book ratio. But we see the numbers are starting to come down. PE, PB, price to sales as well. So that's the content that we have in the blog, and the same is true for every company that we analyze within stockcalc. What this valuation allows you to do is to get comfortable with the fundamental value of the company. Does the company have the cash flow to support the valuation? Is the company well positioned against its competitors, against its peer group in terms of valuation? Is it on the high side? Is it on the low side? Does that present an opportunity for you? So I hope you found this useful as a good overview of the valuation summary. And you can actually go into the website, the stockcalc website, and in the free tools you can run valuations for yourself on other companies, any of the companies that are trading on New York, NASDAQ, Toronto, and Vancouver. So again, thank you for your time, and I hope you found this useful.